Hello trade pros, and welcome to another segment of Driving with George. Today I parked up and I wanted to talk to you about something very important. If you find yourself getting stopped out only to see the trade go back in your direction, and today in the video I'm going to give you a very quick tip that will help you resolve that. Also, this segment is designed for you, so in the comment section of this video please put some questions that you'd like me to cover, and I'll personally create a video for you on my drives to help address some of your concerns, questions, and inquiries. In today's video, let's jump right into talking about stop losses. So here's a very common thing for new traders. They find a level that they like, they look at the trade and they say, all right, I'm gonna get in. After getting into that level, assuming that they wanna see the stock go up and they're trying to get long, they'll put their limit order. Their limit gets filled, and immediately after, their stop loss gets filled, putting another loss in their trading account. Right after that, the market almost certainly reverses and goes up for a 30-point run that you were anticipating all along. If you know that feeling, I know that feeling personally, I'm gonna give you a tip to help you resolve this. So here's the tip. When you're planning your trade, it starts at the very beginning. If you're in the trade, it's too late to be thinking about your stop loss. This is a decision that has to be made before you get into a trade. If you don't know where you're gonna get out before you get in, how will you get out? Think about that. You're putting it into an arbitrary type of variable. You're leaving it up to emotion. You're exposing yourself to a lot of negative things that could happen during the course of the trade. So what you want to do is think about where you're going to get out before you even get in. Here's one way I like to approach it. Yes, I know you like to get long because there's opportunity and you want to make money, or short, whatever the trade might be. But before you enter the trade, ask yourself, where does my stop need to go for me to know that I'm wrong? So for example, if your stop is hit, you want to look at that at 4 p.m. when you're reviewing your journal and say, look, that was a good stop loss because as soon as I got stopped out, the market went lower and I was trying to buy it. So a stop loss is there to protect you from escalating losses, not to get you out of your opportunities prematurely. So what you want to do is identify that level. When this level is triggered, my stop is going to go because I think the long trade is now off. I'm wrong. So find out where you're going to be wrong first and place your stop there. From there, depending on how thick your stop is, that dictates your entry. So let's assume you want to get long in the futures and you've decided on the S&P 500 that 35.84 is a transitional level. Below this level, the market's going to continue dump and you no longer want to buy. So where's your entry? 35.84 plus whatever your stop is. In our case, we use 5 to 7 ticks. So if you're looking to stop out at 84, your entry could be as high as 85.25, or adding a point and a quarter, which is 5 ticks, to your stop loss level. So start with the stop and then find out where your entry is going to be and be patient for that entry. Because if that's happening to you continuously, all you have to do is put your entry where your stop loss is and your real stop loss will go lower. That way, instead of stopping out when the market drops, you're actually getting filled for your long opportunity and you're going to be on board where the market rips. So start looking at the market that way and start the trade by identifying a flip zone or a level below which you're going to be wrong and the market isn't going to go up anymore. This is reliant on really good technical analysis, order flow analysis, and finding key levels. Once you have your transition zone, you now know where your entry is going to be depending on how much risk you're taking per trade with a point basis. I like to use 5 ticks for the S&P 500. I like to use 9 ticks for oil trading. Depending what market you're trading, you're going to know what's right for you. It also varies on the volatility. So I hope this tip has been helpful for you. Remember, start with the stop in mind and you're going to get the limit order to be at an area that makes sense for the market, not for when you want to get in. A lot of the times, traders get in too quickly because they want to participate in the market. They get the fear of missing out. So rather than having FOMO, find where you want to get out, where you're going to be dead wrong, and that dictates your entry. This gives you really high probability entries near key support levels that should improve your trading. So I'd love to hear from you in the comment section below. How is this tip helping you? How have you implemented it? And most importantly, let us know what you want to cover on this next segment on Driving with George. I hit the road often and I love to answer your questions, and this is a perfect place to do it. I have a lot of downtime in the car. So come on over and take a drive with me by putting the question that you have for me in the comment section. Also, remember to subscribe to our channel. We got a lot of great content coming out, and hit the notification bell so you know when new videos are released. Thank you so much for tuning in. Manage your risk and trade like a trade pro. Take care and goodbye.